Welcome back to the Market Mosaic, where every week we are breaking down macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment to try to gauge what the stock market's next near-term move could be. And look, we're right in the middle of receiving some pivotal data that can really change the outlook on what the Fed is going to do with rates and how that's going to impact stock prices. So let's just jump right into it. Last week, we had the August payrolls report. It was a dismal report leading to recession fears, but at the same time, solidifying the outlook for interest rate cuts by the Fed. So non-farm payrolls for August came in at just 22,000. That missed estimates for an increase of 75,000. But we've also continued to see some really big downward revisions to prior months. So June in particular stood out. When the June figure was originally released, it showed that 147,000 jobs were added during the month. That figure got revised down to a loss of 13,000 jobs. The number now shows that there was a loss of 13,000 jobs during the month. So you can see we got this red bar, this down month on payrolls. That ends a streak of 53 months of consecutive gains in payrolls and monthly payrolls. That is the second longest streak on record. You can see it started back at the beginning of 2021, and with that June figure being revised lower, that streak has now ended, and you can see how weak kind of this cluster of recent months, this 4-month stretch, has been. Now, the payrolls figure, it fell, what I would say is it fell outside the Goldilocks zone for the stock market in order to have the stock market have a positive reaction. See, I think a figure that would have been in line with estimates, that 75,000 number, that would show job growth is running weak enough to keep the outlook for Fed rate cuts intact, but it's not so bad to stoke recession fears. But look, coupled with these downward revisions, the August figure, that was a big enough miss to raise concerns about the health of the economy. But like I said, at the same time, that's boosting the outlook for rate cuts. So for investors, you have to weigh the negatives of slowing economic data and the positives of the outlook for interest rates being lowered. But here's the thing, and we're going to go into this. At the same time, there is more evidence emerging that what I'll call the economic fog, the uncertainty, the fog around the trade war, it is finally lifting. Because we're starting to see leading indicators of activity back in expansion territory. Now, that's important because once the Fed does start cutting rates, and again, it looks like September is a lock, and we're going to talk about the outlook for rate cuts here in just a minute, but once the Fed starts to cut rates, the historical data suggests that the path forward for the S&P 500 is going to come down to one thing and one thing only, and that is if the economy tips into a recession or avoids it. So, in today's update, I want to look at the rapid, call it repricing for rate cuts following that payrolls report. But then I want to go into this evidence that the economy is actually picking up, that the economy is accelerating despite what you're seeing with jobs data. And again, that is key to the outlook for the S&P 500 and the rest of the stock market once the Fed does resume cutting interest rates. All right, so expectations for rate cuts. They are jumping following that weak payrolls report. We already knew that during his speech at Jackson Hole, Fed Chair Jerome Powell broadcast this pivot to concerns over the labor market and away from rising inflation. So if you go back to the Fed's last meeting, they were voicing concerns about inflation. Well, Powell flipped that around and put the spotlight on their other mandate, which is promoting full employment. So market implied odds, if you look at CME odds, they currently show 6 quarter-point rate cuts now being projected over the next year, and the 2-year yield is starting to get to that level. The 2-year is still a little bit behind, but catching up to it. So the 2-year Treasury, that's the black line on here, it tends to lead changes in the Fed funds rate. So look at what this goes back to the start of, or at the end of 2021. You can see the 2-year Treasury starting to rise well ahead of when the Fed started to actually increase rates. And the same thing, we had this crossover below Fed funds back in 2023. That signaled the Fed would be on hold, as they were. 2-year Treasury dropped. You start to finally see the Fed start to follow suit. Now, this is interesting. The 2-year Treasury yield came back up to where the current level of Fed funds was, but now we're starting to see it drop again. So right now, 2-year yields at 3.5%. The high end of the Fed funds range is at 4.5%. So that's implying a percent worth of rate cuts. Now, what I would watch is this 3.5% level that we've been at a couple times. If this makes a sharp drop below that level, I think that puts an outsized, a larger than expected rate cut on the table at the next Fed meeting. So keep an eye on that. So here's the thing about recession fears. Recession fears are growing. The market's pricing in more Fed rate cuts ahead because of that. But recall that the labor market data is among the last economic indicators to change in response to changes in the underlying economy. So the labor market, payrolls especially, is a lagging economic indicator. So that's why we had this weak payrolls report, but you also need to take in consideration what leading indicators are now starting to say. So leading indicators are actually starting to pick up, right? So that could suggest that the uncertainty around the trade war from earlier in the year, you're now starting to see that finally reflected in labor market data. We've already seen that reflected in, as it was unfolding, sentiment surveys, some of these more current indicators of economic activity. Well, that stuff's starting to clear up. And now you're starting to see a rebound in some of these leading indicators. So the ISM releases reports on manufacturing and service sector activity. They're structured so that a reading above 50 points of expansion, below 50 is contracting activity. And the headline figures for those reports have still been a bit of a mixed bag. But what you want to pay attention to is the new orders component. The new orders component within those reports is a leading indicator of activity, and they are gaining across both surveys. In the most recent reports, manufacturing new orders came in at 51.4, services new orders came in at 56, so that's a big jump in both reports. But the other thing you want to watch too, especially within the manufacturing survey, is the spread between new orders and customer inventories. So both of these things would indicate a pickup in activity, and what you want to see is a large spread between the two. So new orders picking up is kind of self-explanatory, while if customer inventories get too low, that could indicate restocking demand. So what you want to see and what you want to look for is a wide and growing spread between these two. That's a positive for the economy, and it's 1 month, but we had a nice move in the right direction in this indicator. So you're starting to see that gap grow. You had the big jump in new orders, and you still got a pullback in the level of customer inventory. So keep an eye on that indicator. All right, so clearly concerns over the labor market are taking precedent. That's where the investor focus is right now. But do not forget, we are seeing inflationary pressures continuing to build. Various core consumer inflation measures are running around the 3% level. That is well above the Fed's inflation target of 2%. But the thing you need to be concerned about is that assets in areas of the market with high inflation betas are warning about upside surprises. So high inflation beta means something that does well when inflation is rising. So just look at gold. Gold has a high inflation beta. Gold is now breaking out again to record highs, hitting near the 3,600 per ounce level. But the next one you want to watch, gold's in the headlines, but the next thing you really want to keep an eye on is with broader commodities. You can track broader commodities with this ticker on here, GSG. This is the S&P GSCI Commodity Index Fund, and it is trading near the high end of a multi-year basing pattern. This is very significant. Look how far back this goes. This goes back to 2022, and we've been in this tightening range, so you're making higher lows along the way while coming back to test this level around the $24 level. If that would point and potentially points to a major breakout higher happening in commodity prices. Why is that concerning? Well, look, the last time we had a big inflation wave that peaked in mid-22, this is what you had GSG doing. You had commodities, and this makes sense. Higher commodity prices are going to fuel inflation pressures. Well, you had this big run in GSG into mid-22. This is when inflation peaked, right about the time GSG peaked. All right, so keep an eye on this. If we start to see a breakout over this 24 level, this could be the next big warning that inflationary pressures are building, which comes at a time when the Fed is hoping, or investors are hoping, that the Fed can really start to slash interest rates right here. So following there was an initial positive market reaction to the August payrolls report because the weak number that put up hopes that we're going to see more rate cuts, but stocks quickly reversed those gains. The S&P did go out to a record high, but then turned around and closed lower on the day. So recession fears, that could definitely become a narrative that weighs on the S&P 500 over the near term, and I would keep an eye on it because that would align with a period of seasonal weakness that we're entering. So what this chart does is it plots the 4-year presidential cycle for the S&P 500. This goes back, uses data going back to 1928. The blue line shows the average movement during a post-election year, and you can see the S&P is actually tracking pretty close to this, especially considering earlier in there. Looking back on history, you tend to see a peak in February. We had a peak in February at the start of the year, a pullback into March and April. We had the pullback into March and April, and then a rally to new highs in the summer months, and that's exactly what we've seen. But this would be the time, right around the time, where you'd start to see a pullback in the market happen now through most of October. So keep an eye on this. If we start to see these recession fears start to drive the narrative more, that would line up with a period of seasonal weakness that the S&P 500 tends to see anyways. While seasonal trends, they could point to some weakness ahead, the longer term path for the S&P 500 is going to come down to the economy if and when, not if, but when the Fed starts cutting rates again. So the chart on here, it plots the S&P 500. It looks at past instances when the Fed has held interest rates steady for at least 6 months. So the Fed has been on hold since last December. So we're going on month 8, month 9 of the Fed not doing anything. And once the Fed starts cutting again, the forward path for the market, it depends on the economy avoiding recession. So the dark blue line on here, this shows what happens to the S&P 500. So from the point right here where they start to cut rates, what happens for the next 12 months when the Fed starts cutting rates if the economy continues to grow? You get this dark blue line. If instead we see a recession, you get the gray line. And this makes a lot of sense because look, over the long term, stock prices are going to follow earnings. And the earnings picture, the earnings outlook depends on the strength of the economy. And so we're looking at a Fed rate cut starting in September. If we start to see another cutting cycle, again, it's going to come down to what the economy does. And this is going to be in focus because when you look back historically, a lot of times when the Fed is cutting aggressively, it's because signs of a recession are already stacking up, but the Fed's just too late to act and they can't head off the recession. I mean, you look at how many instances we had 4 times where the economy continued to grow, 4 times where it fell into recession. So we'll see what this time holds. But again, it looks like based on some recent evidence, recent data, that we are starting to see the economy accelerate, that things are holding up just fine despite the weakness you've seen in payrolls recently. All right, so huge week ahead, focused on 2 reports. It's going to be all about 2 reports, and that is the PPI producer inflation report and the CPI consumer inflation report. So the Fed's 2 mandates under scrutiny right now. We just had that week payrolls report, and that is upping the odds that the Fed's going to more aggressively. Well, the other thing you got to consider is if inflation keeps coming in hotter. So pay attention to the CPI year over year as well as the core figure. The year over year headline number came in at 2.7% during July. That's expected to accelerate to 2.9%. So keep an eye on that number. Same thing with the PPI. The PPI was way hotter than expected back in July at 0.9%. The market, economists right now expect that to moderate back down to 0.3%. So we'll get the PPI out first, and then CPI. Keep a close eye on those 2 reports. That is going to drive the action in the stock market over this coming week. Last thing, let's take a look at a chart set up in the market that I think you have to keep an eye on. This stock, Tempest AI, it checks so many boxes for being a high growth setup, something that can be absolutely explosive on a breakout. It's a relatively recent IPO. It's leveraged to the AI theme, utilizing AI in the healthcare space. And this is just a great example of accumulation, evidence of accumulation in a base, because after the stock peaked out around the $90 level, we had a pullback. This was back in February. We had to pull back into early April along with the rest of the market down to the $40, rallied back toward resistance, smaller pullback, got even closer to the prior highs, much smaller pullback. That's what you want to see. These smaller pullbacks indicate, and these higher lows along the way, that indicates buying pressure in the name. And so that's the condition you want to see to help support a breakout. So we're going to keep an eye initially on this $80 level. That's a near-term resistance level being created, but then ultimately you want to see a breakout to new highs over the $90 level here with ticker TEN. All right, that is all for this week. Thanks for